Welcome to Exit Math and Valuation. So it's important to know your number, your valuation number, and the levers that move multiples. And it's also critical to understand what are the fundamentals, how to maximize your exit value, and things like that. So why does valuation matter? Why it matters is because buyers pay a multiple of earnings. Okay, they pay a multiple of your annual profits, or in some cases revenue if it's a strategic acquisition. But if you don't speak their language, you will lose leverage. Okay, and buyers, they know exactly how to run certain valuation methodologies and how to understand financials and certain metrics. So this is why that's important. And we'll also get a defensible range and the levers to push your valuation higher. Okay, so what are the three valuation lenses? The first one is called SDE, Seller's Discretionary Earnings. And what is that? It's basically, first of all, it's a metric that is used for businesses under 5 million in revenue, so smaller businesses, and it adds back owner compensation and a few other deductions into the profit, so your overall profit becomes a little higher than it would have been beforehand. And what is it? It's basically this formula right here, which is revenue minus COGS minus operating expenses plus owner compensation, perks, and one-offs. The second one that is most common is called EBITDA. Okay, so earnings before interest, taxes, depreciation, and amortization. And here's the kind of formula for that. So it's net profits plus interest, taxes, depreciation, amortization. And this is the most common one that businesses will use, and you'll see it the most whenever you're looking at a business for sale, because most businesses for sale are over 5 million in revenue. And then there's also revenue multiple, which is it's used primarily for high growth software or subscription businesses, because most times the future probability, the potential and revenue and opportunities exceed the current earnings. And what drives multiples higher? What's the most important is trailing 12 months. A consistent year-over-year growth demonstrates market traction, scalability potential. So this is a quite important metric to keep track of to make sure that you're consistent in revenue or slightly growing. And also quality margins are important as well. If you're running, on a 30% gross margins, 30% gross margin, then it's going to be much harder to generate a good net profit margin. So that's why margin quality is important. Something that has 60, 70, 80% gross profit margins is a good sign to a buyer. Also, recurring revenue. So, businesses that have recurring revenue like software or e-commerce businesses with some sort of subscriptions, this is more predictable and it almost guarantees a future revenue for the business. So this is why buyers might like them more. And also owner independence is important as well, because buyers want to see that you're removed from the business and that they can step into your shoes and the whole operation runs and it keeps on running. And what's also important is a diversified risk profile. So multiple revenue streams, multiple customers, and channels that will reduce concentration risk. If you have a brand that's running and making revenue only from Facebook ads and your ad account gets shut down, well, good luck, your revenue's gone. Also, documentation quality is important, clean financial records, clean books, and SOPs. Another thing we need to know is strategic add backs. So this will help you bring up your total net profit or adjust it to look higher, because there might be some one-off expenses that don't apply to the next owner. And what that could be is, travel, meals, maybe some kind of legal expenses that the next owner won't incur. And another thing is, if you're paying yourself a higher market rate for your own salary, let's say, for example, your e-commerce brand makes 500K annual profits and you're paying yourself 300K of that per year, that's a little above average of what a typical CEO might make. So you can add back some of that salary into the net profit. Okay, so this can bring up your total net profit to where when you're running a valuation, you get a higher valuation. Okay, and you have to be pretty conservative about this, like don't overdo it. But here's how it might look like. So for example, gross sales 1.4 mil, returns and allowances adds up to 1.45 mil, and then minus COGS, and then you see here that we can add back the salary, we can add back taxes and licenses, charitable contributions, large tools, depreciation, and all of these other expenses. And instead of your total expenses being 875K, now they're 690K, and your total net profit goes up. So that's why this is important to do. And another important thing we could do is comparable analysis and strategic anchoring. And how we can do that is we can look at platforms that sell businesses and look at what's been sold. So you can go into, for example, Flippa. So let's do that. We can go into Flippa, we can go to search, and whatever your business model is, you can search it up. But for this example, we'll just select every asset type there is here. And then you scroll down and you have to find the recently sold section. And here we can see what businesses have been sold, the multiples on profit, on the revenue, and depending on what your business is, you can enter some keywords, fashion, e-commerce, or something like that. You can see what it's been sold for. So this will give you a good idea of what the current market multiples are. And using these comps, we can set a realistic valuation range, not a single point estimate. And this range kind of provides us with negotiation flexibility. And what we can also do is anchor this with a good story. What we can do is we can write a great narrative around growth of the business, the quality of the business, maybe some certain intellectual property that's really important and that raises your valuation. So all of these things are quite important to do. So what are your immediate action items? The first is to try our valuation calculator, and I'll kind of show you how that looks. So here's how we can use the spot. What we have to do is enter start. What is your priority? Are you looking to sell it quickly, or are you looking to maximize value? You could do first one, sell quickly. Choose the model, commerce. And then enter in your net profit. Say ours is 5 million. And then we should enter in our current physical assets. Let's say we have, 50,000 in inventory. And now we can see here, the low valuation is 3.6 million, average is 7.2, high is 13.6. And this uses market comparables that we've already compiled from a bunch of different websites, a bunch of different brokers, investment banks, and it gives you a good valuation range. So that's how that kind of looks. Another thing that we discussed was research and save some comparable transactions. This will give you a good idea of the range that you can set it at. And then we should also create a short document with the most valuable points about the company. They'll also help with the valuation. So this was this module, and moving on to the next one, it's going to be prep and packaging.